Right. So inflation. So your outlook there is inflation sitting quite high now, a record for some time now. So what's going to happen with inflation?
Well, inflation, of course, is I mean, it reached 7.3% in the June quarter, and we thought, well, it will come off from there, and it didn't come back as much as we thought. We were wrong, but we were the least wrong. Yeah, so it came back to, I think we had about 6.8, and it came to 7.2 on a year-on-year basis. And so inflationary pressures are really strong for the reasons I've outlined. Too much demand, supply unable to meet that demand. Some of that is tradables, what we call tradables inflation, which basically is imported. Some of it's domestically sourced. Now, this chart that I'm putting up now shows headline inflation, and in it shows inflation if you take out the volatiles. So that's things like energy prices, which tend to move up and down.
Right.
It's affected by the currency. But if you strip those kind of volatiles out, you can actually see that inflation is still, kind of mid-sixes, non-volatile inflation, for want of a better word. So it's really strong. So that inflationary impulse is strong. And a large part of that has to do with what's happening domestically in terms of what we call, as I said, non-tradable inflation. And a large part of that has to do with what's happening in the labour market and has to do with wages.
Right.
And the increase in wages that we're seeing at the moment.
Right.
So our outlook for inflation, and we unfortunately we don't show it in this chart, we expect inflation to come off from these highs. We expect the tradables component to possibly come off faster. That hasn't been helped, though, by the exchange rate.
No.
Which has depreciated, and it wasn't something that we really and they originally anticipated the extent of US dollar strength.
Yes.
But it certainly has contributed. We have seen fuel prices moderate a little bit. That hasn't been helped recently by OPEC cutting production. And of course, the ongoing war in the Ukraine also contributes to that. If we look domestically at the non-tradable component, so we think tradables will come off, maybe not as fast as we thought, but will come off faster than non-tradable inflation, which is domestically produced inflation.
Right.
The issue there is wages now are becoming entrenched, and the wage expectation spiral. Wages go up, prices go up. I need more money. I need my wages to increase to pay for that, and it becomes a negative spiral.
Yes.
And we've got to break that. And the way the Reserve Bank breaks that is by hiking up interest rates.
Right.
So that's where we are at the moment. So we expect non-tradables to basically also decline over time, but will take a lot longer because of this cycle that we're seeing. And we're only picking probably into about 2024. We'll actually see it move within the 1 to 3% band that we've got in this chart.
Right.
Unfortunately, I'm not showing it on the chart, the outlook, but you understand what I'm trying to get at.
Yes.